Something is breaking in copper markets. Right now as I speak to you, copper just hit $13,400. That's per metric ton. It's an all-time record. Over the past 12 months, copper surged 52%, from 8,700 to 13,400. Before I show you why banks are trapped, hit subscribe right now. This channel reveals financial crises before mainstream media catches on. You'll want these alerts. Now let's continue. Most people think this is supply and demand. They're wrong. This is a derivatives time bomb. Banks are sitting on $800 billion in commodity exposure. $800 billion? That number should terrify you. Let me explain why. Copper now trades at 121% above production cost. 121%. That means prices are double what miners spend. When commodities get this expensive, something always happens. Either supply floods in, or demand crashes. Neither has happened yet. That's the danger signal. Banks sold derivatives when copper was 9,000. They bet prices would stay stable. They collected premiums. They felt safe. Then copper exploded past 13,000. Every dollar above their strike price is real money banks owe. These aren't paper losses. These are cash settlements coming due. Banks tried to hedge. They shorted futures to protect themselves. But copper kept rising. Their hedges became worthless. They had to buy futures at higher prices. This locked in massive losses and pushed prices even higher. It's a death spiral. Let me show you the three forces driving this. First, supply disruptions at major mines. Kamoa-Kakula in Congo has problems. Grasberg in Indonesia has issues. These aren't weather delays. These are structural failures. Mining can't adjust quickly. New projects take years. Existing operations can't just produce more. A second, speculative positioning reached extreme levels. Hedge funds went massively long. Commodity traders piled in. This isn't industrial hedging. This is leveraged speculation. These positions use borrowed money. They can reverse violently. When margins get called, positions liquidate fast. Banks facilitated this speculation through prime brokerage, through their own trading desks. Now they're exposed to catastrophic reversals. Third, U.S. companies are panic buying. Tariffs are coming in January 2027. 15% on copper imports. Potentially 30% by January 2028. Every U.S. manufacturer is stockpiling. Since April 2025, COMEX inventories surged 300,000 tons. 300,000 tons. That's metal pulled from circulation. Creating artificial tightness everywhere else. This created a dangerous arbitrage. COMEX copper costs more than LME copper. New York prices exceed London prices by significant sustained amounts. Normally these markets trade at parity. The arbitrage should be simple. Buy cheap in London, ship to New York, sell at premium. But the arbitrage is overwhelmed. Every U.S. buyer is front-running tariffs, all at the same time. Now here's why banks are in trouble. They're exposed through multiple channels simultaneously. They financed mining companies. They hedged for industrial users. They run proprietary trading. They wrote options and swaps. Most dangerous, they sold structured products. These products promised returns if copper stayed range-bound. Banks pocketed premiums, but copper breached every barrier. Now banks owe billions at maturity. Let me walk through a specific scenario. European bank sells $10 billion in copper-linked notes. Barrier level set at $12,000. Copper stays below $12,000. Bank keeps premiums. Life is good, but copper just hit $13,400. Barrier breached. At maturity, bank owes $10 billion. Where does a bank find $10 billion cash? They sell other assets. They liquidate positions. They borrow frantically. If multiple banks face this simultaneously, assets get dumped everywhere. Liquidity evaporates, credit markets freeze, but it gets worse. Mining companies hedged future production. They sold forward at $9,000. Now spot price is $13,400. They lose $4,000 per ton on every hedged ounce. These are cash losses, not paper losses. Companies can't meet margin calls. They default on bank loans. Banks eat the losses. Industrial consumers also suffer. They locked supply contracts at low prices. Suppliers can't deliver profitably now. Consumers must buy spot at $13,000, and that's $4,000 more than expected. Profit margins vanish. Cash flow turns negative. Creditworthy borrowers suddenly face default. Now the tariff trap. 15% tariff means $1,950 extra per ton, on top of $13,400. For U.S. manufacturers, this is catastrophic. But if they don't stockpile now, later is worse. So they keep buying, driving prices higher. Making the problem worse, the U.S. imports half its copper. 90% from Chile, Canada, Peru. Tariff adds $1.35 billion annually. $1.35 billion every year. Where does that money come from? Higher consumer prices, or lower company profits, or both. That's deflationary for activity, inflationary for prices, the worst combination possible. But here's the real kicker. The U.S. doesn't have idle smelting capacity. Building new smelters makes no economic sense. Even at $13,000 copper, labor costs too high, regulations too strict, energy too expensive. The tariff achieves nothing except making copper expensive and generating tax revenue. Most likely outcome is a Chile deal, tariff-free access to Chilean copper, in exchange for supply commitments. If that happens, the COMEX premium collapses overnight. All that stockpiled inventory becomes excess supply. Prices correct sharply, violently. Everyone who financed the inventory build loses. Everyone who went long loses. Here's the systemic risk. Banks are exposed on all fronts: derivatives, loans, proprietary positions. And critically, counterparty risk. If one major player fails, others scramble. Assessing exposure. Liquidity disappears. Remember Lehman Brothers in 2008? It didn't collapse alone. It triggered cascades. Copper caused crises before. 1996 Sumitomo scandal. Rogue trader Yasuo Hamanaka manipulated copper for a decade. Accumulated massive long positions. Scheme collapsed. Sumitomo lost $2.6 billion, but damage spread wider. Copper crashed. Banks lost money. Credit markets tightened. That was with copper at $2,000. Imagine similar failure at $13,000. Another warning sign is correlation breakdown. Normally, copper moves with other metals, with economic growth. But copper decoupled recently, surging while aluminum zinc stay flat. This suggests financial speculation, not real demand growth, that makes current prices extremely fragile. If sentiment shifts, copper falls fast. Demand destruction is starting. Ole Hansen at Saxo Bank warned, copper reached levels where demand dies. Manufacturers delay projects. Engineers redesign products. Use less copper. Construction scales back. Electrical costs too much. These adjustments happen invisibly, until demand drops noticeably. If copper corrects from here, even modestly, small moves trigger big consequences. Stop losses get hit. Margin calls force liquidation. Algorithms detect momentum shifts. A modest correction cascades. Copper drops from 13,000 to 11,000. That's 15%. Speculators leveraged 5 to 1. They lose 75%. Forced liquidation accelerates decline. Prices overshoot downward. Could hit 9,000 before stabilizing. For banks, that's a nightmare. Structured products breach new barriers. Hedges become wrong. New delta exposure appears. Loans to companies default. Revenues collapse. Shareholders demand answers. Regulators investigate. But risk isn't just downside. Copper could rise further, to 14,000, to 15,000. Losses expand proportionally. No ceiling stops the pain. Banks sold options, assuming copper never sustains above 10,000. Every thousand above that is uncontemplated exposure. Tin market shows what's coming. Tin surged 24% Shanghai, 30% London, since January 2026. Analysts admit no fundamental reason, pure speculation. If tin can move 30% in 3 weeks, copper's reversal will be just as violent. Chinese copper hit record highs. Shanghai Futures Exchange, 105,650 yuan, equivalent to 15,000 US dollars. Shanghai prices exceed London. Highly unusual. Suggests extreme tightness. But is it real or artificial? Possibly stockpiling before Lunar New Year. Those inventories hit markets eventually. Adding supply pressure, Bernstein uses margin reversion framework. Buying copper at 121% above cost delivers negative long-term returns. Data is clear. Expensive copper eventually reverts. Question is only timing. Problem for banks is timing doesn't matter. When managing daily margin requirements, inventory to demand ratios are 9 days. 9 days of global consumption. That's incredibly thin. No margin for error. Any supply shock causes spikes. Any demand slowdown builds inventory fast. Market balanced on knife edge. This parallels nickel crisis. March 2022. Tsingshan Holding Group had massive shorts. Nickel spiked from 29,000 to 100,000 in 48 hours. Tsingshan couldn't meet margins. LME panicked. Halted trading. Canceled $8 billion in trades. Changed rules retroactively. Complete market breakdown. Same could happen with copper. If LME or COMEX halt trading, legal chaos follows. Financial chaos follows. Hedges get voided. Profits get erased. Regulatory scrutiny increases. When commodity prices surge, politicians ask questions. Congressional hearings get scheduled. Banks face reputational risk. Biden administration already threatened tariffs. What stops windfall profit taxes? What stops speculation restrictions? Any measure forces banks to reduce exposure, triggering market disruption. So where does this leave us? Copper at all-time highs. Trading 100, 21% above cost. Driven by disruptions, by speculation, by tariff hoarding. Banks have massive derivative exposure. Market structure is fragile. Thin inventories, elevated speculation. Price dislocations between exchanges. Multiple scenarios exist, all bad for banks. If copper corrects, speculators default, loans go bad. Derivative losses mount. If copper stays high or rises, losses on shorts expand, margins increase, demand destruction comes eventually. If tariffs imposed, costs spike, economic damage spreads. If tariffs avoided through Chile deal, arbitrage collapses, COMEX inventory liquidates, window to reduce exposure is closing. But reducing exposure when prices are parabolic means locking in catastrophic losses. Banks are trapped. The smart move was never build this exposure, but that ship sailed. What happens next depends on unpredictable factors. Will U.S. impose tariffs or deal with Chile? Will Chinese demand sustain? Will speculators take profits? Will supply disruptions resolve? Each variable affects copper's path and bank solvency. One thing is certain. Current situation is unsustainable. Copper cannot trade 121% above cost indefinitely. Either supply increases, demand decreases, speculation unwinds. Any outcome means lower prices. The question is, how violent? How much collateral damage? For observers, the lesson is clear. Extreme commodity moves driven by speculation create systemic risks beyond the commodity. Banks aren't passive. They're active with enormous leverage, hidden exposure. When prices reach extremes, exposure becomes dangerous. When multiple banks face similar risks, individual failures cascade. We've seen it with oil, with nickel, with natural gas. Now we're watching copper. The question is whether authorities can manage the unwind without triggering system-wide crisis. Based on history and current positioning, the odds aren't good. This is the copper time bomb, and the fuse is burning.